Morning, everybody. How are we doing? Morning, Evil. Morning, FT.net. How are you all? Why is my camera so dark today? Weird. Morning, everybody. How are you doing? Right. So this morning we are going to cover the ORB version 2 test results that I've got so far. And what my plans are moving forward. I'm just trying to find them, making sure I've got them open, which I haven't. So yeah, just going to go through the results today and have a look at what is and isn't impacting the results. Yeah, and basically how it's all working. So I found a bug in the EA. Not a bug. It's just there were certain trades it wasn't taking. So it wasn't really a bug. It was just kind of a different approach. So what it was doing by accident was if it took placed a pending order on either end, and this one within 15 minutes closed out either in a profit or a loss, that 15-minute pending order vanished. Because the way I'd coded the EA to remove the pending orders every 5-minute interval. So it didn't make a massive difference to the results, but obviously it isn't the strategy. So I've had to redo all this testing again. So we'll go through that and I'll show you the EA in action. I'll show you the theory behind the strategy. And then I'm going to look at basically where I'm going to go with it from here, which, to be honest, there's not too many routes because it needs to be kept as simple as possible to make sure it's robust. But there are ways and means of potentially improving it with moving averages and potentially with trailing stops. So I'm going to investigate those. Those will be the next round of testing. And then I'm going to put it live, forward testing, because it does very much similar to what the ORB does and SIH. Yeah, so it's not, there's no danger in testing it. Because obviously it does the same thing. It breaks the opening range. So we'll go and look at that in a bit more detail. But first of all, we're going to go through the news, the zones, the trades that are open, which there isn't a lot of, and just analyze what happened to FOMC yesterday, because it was the most lackluster FOMC I've seen. I was expecting something much more exciting and explosive than what we got. I mean, we didn't move. I was expecting this to be a big one. Now Trump's in and, yeah, I don't know. Fed just didn't do anything, did they? Didn't say anything. So we're going to have a look through that. Morning, Vitaly. Looking forward to ORB V2. I think it's going to be my main futures strategy. Yeah. Could well work for that. Leon, morning. Barry, morning. Right, so let's just kick off with the news to start off with. So yesterday, obviously, we had the Fed rate. The overnight rate for the CAD came out at 3. We were on for that yesterday afternoon. Didn't really do an awful lot. The Fed fund rate came out at 4.5. I thought there was a slight possibility we might get 0.25% with Trump bending the arm behind Powell's back, but it didn't happen. So we got exactly what we were expecting. The FOMC press conference last night was financial juice. Was just bizarre. So obviously we know that there's not a lot of opportunity for the Fed to drop rates. We're not expecting the Fed to drop the rates. So they're going to do it a couple of times this year. So this is basically the interest rate decision at 4.5. We had that little spike, and it's just basically a little bit of whipsaw. It was kind of less than 20% of ADR. We just didn't really move on it. Then basically Powell came out and said a lot of things, but traders price in less Fed easing this year after the FOMC statement. So there was nothing much in the statement, and we're expecting them to do a couple of rate cuts, and I think that's probably what the market is still expecting. They now expect June to be the first round of rate cuts, but based on obviously what the inflation figures do. Trump didn't say anything. I was expecting Trump to come out and say something as well, but he didn't say anything. So he kept his mouth shut, and I thought, right, that's fine. He's going to wait for Powell to speak, and then Trump will come out. So the main upshot of what Powell said was we do not need to be in a hurry to adjust the policy rate. So we're not going to adjust the interest rate because this inflation is still sticky. So we're not in any hurry to drop it. We're focused on real progress on inflation or weakness in the labour market before making further cuts. So he's basically saying we are going to focus on getting that inflation figure down to our 2% target, and then we're going to start looking at cuts. And then he comes out 20 minutes later, ignore that one, it doesn't mean anything. Comes out 20 minutes later and says we don't need to wait for the 2% to do the rate cuts. So in one sentence, half an hour between the two sentences, he's saying we are going to wait, and then we're not going to wait. So basically the market, I was watching the market and futures, it just did this because everything he said was contradicting the other thing. And it's a very typical thing that the Fed do when they haven't got a bloody clue what they're doing. They've done it many times before. They're stuck. They don't know what to do. They don't know how to do it. And now we've got Trump involved. They've got nothing but pressure to drop interest rates, and they do not want to do that because inflation won't come down. So the upshot of FOMC yesterday, and this is what I was kind of scrolling through, Trump then didn't actually say a word. I was expecting him to attack Powell for not dropping the rates, but he didn't do it. So, yeah, interesting. I don't know what to make of it. We're stuck. That's the wrong chart. We're stuck. As you can see, Euro US dollar yesterday did nothing. This is FOMC here. And that's it. That's what we got. Got nothing. So US dollar, no clue. Canadian dollar, very little yesterday. Again, nothing off the CAD. So the market's in some kind of weird shock state at the moment where it doesn't know what the hell to do. So we'll wait and see what happens. But yeah, at the moment, I think we just got to basically think about what's going to happen next for the dollar moving forward, which is virtually nothing. So so basically, yesterday I was stuck in EuroCAD and I didn't manage to get out of it. I'm still in it, waiting for that to do something. We've been stuck now for 2 days since the drop, so it started going on its way to where I wanted to go, which was into profit, obviously. So that hasn't moved. Morning, Lucas. There's been no new trades taken. We've got no ADRs again. RSIs are flat. We're just about managing to get RSI extensions on the hourly time frame on the N pairs. Everything else is dead in the water. Pound odd's the only thing that's moving, which I'm already out of. So it's just this week has just been a no opportunity week. Can't really do anything with it. So stuck. Everything's stuck. We have got one weekly on the Aussie dollar yen. That's the only thing that's managed to hit its weekly range. We're on Thursday and it's bouncing beautifully off 2-week low. So looking for it to come back up somewhere into there. A lower high would be here. So there's a long opportunity on Aussie yen. But I'm not trading any yens. So there is an opportunity on that. As much as I'd love to take it, I'm not going to. So there we go. So that's the news. Today we've got the euro rate at 115. So I don't think we're going to get an awful lot of market movement this morning because we're waiting for that euro rate to come out. We've got then the normal unemployment claims and GDP figures for the US, which could move it a little bit. And then 145, we've got Barrier Man and the press conference. So potentially some movement off of Lagarde, but Lagarde's not going to say anything but well done, everything's going well, CPI is dropping, we can keep dropping interest rates, and this is going to carry on going. Well, not that one, that one. It's going to carry on going down. There's absolutely no reason why they shouldn't continue to do what they're doing and get that interest rate down further. So as you can see, the Europeans are the only ones really that are making substantial continued progress on dropping interest rates and keeping inflation under control. Good job. So continued neutrality stroke weakness for the euro. Morning, Mark. So yeah, there we go. That's it. Not a lot else really to report on the news side of things. DAX short break today, hedge on the FTSE. I'm fast becoming bored with this spread on the FTSE. It's utterly ridiculous. I've got to find another broker. Darwin X is too big. I looked at Global Prime yesterday. They're too big as well. I can't find a broker with a decent spread apart from TD365 on the FTSE. but TD365 don't have fixed spreads on MT4. So I'm going to check them out and potentially do trade on TD365 maybe, but this FTSE spread is just getting ridiculous now. And I don't think it is my broker. I thought it was. I've looked at a few other brokers, and the spread on the FTSE for some reason is just fast at the minute. I don't quite know why, but anyway. So we'll come back and look at that a little later. That's it for overnight news. There's nothing else exciting to report. So just quickly going through the RSI mean reversion. There haven't been any signals this week. Nothing's happening on this at all, so that's nice and easy. We've got the ADR reversals. Didn't bank anything yesterday. There were no new trades yesterday. I've got Euro Swiss and Aussie Swiss. We haven't had any ADR hits much this week at all, so I've got those two on still, which are flip-flopping, as you can see, for the last 2 days, not going anywhere at all. Zones I need to whiz through, so we'll go through these. Banked one yesterday, but we'll go through these quickly this morning, and then we'll get on to the analysis. Morning, James, if I didn't say morning. Can't remember. Right, there we go. So let's crack on with those. I was fiddling about with my VPS and everything. It's my OCD kicking in. Everything's got to be perfect. Right, Aussie CAD. So let's start with these. This will be quite quick this morning because I went through them yesterday and really not a lot's happened yesterday. So I don't think we're going to have much different. So 17% banked this month, which is fantastic. Shorts on Aussie CAD. It's in profit at the moment, looking for a continuation back down to retest the lows. I haven't really gone very far. Aussie dollar Swiss. Long on, not gone anywhere in the last day or so. So again, just missed my entry on the Aussie Swiss yesterday. Literally missed it by a tick. So I'm looking either for a retest of this area still and a bounce and then come up into this gap or not. Aussie New Zealand, no trades on, looking to get in short on this. Bit of a mess this one, so I'm just looking for something of a pullback to short that and start an entry. Aussie US got longs on, didn't manage to get anywhere yesterday, didn't get down to the next zone, and we're pushing back up again today, so just waiting for it to either go or to come down so I can get another one on. CAD Swiss, bang on break even at the minute, long on it. Not going to get in another long until we hit the lows, and then I'm going to get out of those highs. Euro odd, shorts at the highs for the next entry, and then obviously looking to come down here. Everything's really range bound at the minute, or it's on its way breaking out of a range, but there's nothing with any power at the moment. We're very, very slow everywhere. I think everyone's just still waiting for Trump to announce what the hell he's doing with these trade tariffs. Tomorrow is the last day of the month, by the way, and on Saturday, as it stands right now, Canada are getting 25% tariffs slapped on everything. Whether that's going to happen or not, we'll have to wait and see. But as it stands at the moment, that is still in place for the CAD tariffs to kick in on Saturday. So we may well get some movement over the weekend as that's all announced, and then obviously some gaps on CAD pairs. But we'll see. I mean, the gaps on the CAD pairs will obviously this will go up because the CAD will weaken. So we'll see what happens with those over the weekend. Not going anywhere. Just go somewhere and either get me out or get me in. Same with this one, Euro Swiss. Next entry, long from that support. Want to get out at the highs. Euro Pound. Looking for my exit. So if you remember this profit yesterday, this 0.5% was those two. So I took a partial on this yesterday, just in case this held. And the reason I took that partial should be pretty obvious. I think I covered it in the live room anyway. But obviously these lows here that we rebought, we hit it and tested it again. So I said, right, I'm going to get out of half just in case we're not going to come and test this. and then we hit it again, and then we hit it again, and we're hitting it again now. If this breaks today, we're off, and this is where the bull move started. So I will be completely out of euro pound shorts there. I think there's a good possibility of retesting. You can't see it. I think there's a good possibility of retesting this propulsion gap here. So that's kind of the propulsion gap, which is this accumulation. But what I'm concerned about is not being able to get through this breakout high here. If this is where they're going to hold it, this isn't going to get done, and we're going to get an orphan propulsion gap. However, you know, it's on its way there, isn't it? And the way that it's rolling over is kind of indicative of, yes, we're probably going to get back down here. But obviously today we've got the rates. So when those rates come out and the press conference happens today, I mean, if we can get down there before the rates, fantastic. Unlikely. What we're likely to do is sit here all morning until the rates come out. So I wanted to get out of some while I had the opportunity yesterday. Still got the 3 on, obviously. But, you know, we'll see where it goes. Euro New Zealand, not gone anywhere. Sideways. Euro US, I'm back at average still, can't get anywhere on it either. Pound odd, looking for that pullback entry, it won't pull back, so can't get in. I don't really want to force a trade on it. It's $4.60 swap on it, so it's getting to the point where I'm getting like, if it goes over a fiver, I'm not interested. So I'm not. You could look at a retest of this propulsion gap for a long, but I mean, we're really extended, and I think we probably want to pull back on that at some point. So I'm just going to leave it there for the moment. I'm not that keen to get into it. Pound CAD, looking for a nice entry on this. Again, retesting this area here. But we haven't gone anywhere. Pound Swiss, same thing, not going anywhere. Pound US, shorts on at the minute. Again, we're just not going anywhere this week. It's just dead. Very weird. We've got interest rates galore this week. FOMC, everything happening. Trump doing all sorts of stuff, and the market's flat. It's also earnings fortnight. Nothing. It's like someone's just turned off trading. It's weird. Anyway, pound US not going anywhere. It's starting to look like we might break down, but this level is holding really, really, really well. When that breaks, we're off. But we can't break it at the minute. So hopefully we get some bull news on the US today with unemployment numbers, and that rallies with the CAD, and the CAD rallies with the US, and we'll get that push breakdown starting. But yeah, can't go anywhere. It's stuck. New Zealand Swiss, again, sitting around, waiting, go somewhere or don't, I don't care. New Zealand US, not going anywhere really. Moved down, moved up, moved down. Can't quite get to my profit target, which is here. How much have I got on that? New Zealand US. And there's an argument for shutting a couple of these out and just banking 1% today, but that gap feels near as damn it done. So I'm going to give it the news, see if the US dollar news can drive the dollar today. We'll see. US dollar CAD not going anywhere, stuck, and I just want to break even on this. Just trying to get out at a break even now, because we are really, really, really stuck on that, and that's it. So US dollar Swiss, longs on that. Don't see any reason why I shouldn't hold that really. Swiss should continue to be weak because I keep talking about negative interest rates, and we don't seem to have any weakness on the dollar or strength. So this will be basically good news for the dollar, wicked, bad news for the dollar, not so good until it does get some. So, or Trump opens his mouth and does something. So we're really, really stuck on everything at the minute. Bit of a funny old week, but is what it is. Nothing you can do about it. This is our job, is to sit in the market and wait for the market to move and then adjust accordingly. And the market isn't moving, so there's nothing to do. These are the weeks where you just sit around and do other things, basically. Anyway, so Great, DAX is hedged as well. This week's been absolutely terrible for the ORB. After the beginning of this month was amazing. ORB was absolutely flying. We've had 3 days of losses, but that's the way it goes, isn't it? That is what indices are like. You make money on indices when indices move. When indices don't move, you don't make money. When they move, you make a lot of money. At the minute, these things are shot. If you look at the higher time frames on everything at the moment, you can see what it's just, a bit there, but it's terrible. The DAX is trending like a crazy thing at the moment, but the actual opens are very sort of lackluster. I think the DAX yesterday, was it the DAX that was a profit yesterday or the FTSE? No, the DAX was a loss yesterday. The FTSE was a profit. No, the FTSE was a loss. Which one was a... Oh, no, all four. Sorry, yes. All four yesterday were losses. I had a hedge recovery. I had an exit there for about £150. And I watched it just before FOMC. And I was like, shall I? No, I didn't. Then it went up. So yeah, I could have got out of that without a loss, but yesterday it was about a 350 loss. I've got a feeling there was nothing actually yesterday that profited. Yeah, that was a hedge. That was a break even. Yeah, that was $10. So that was a clean break south yesterday, the Nasdaq. It missed 3R target. You can see there this was the most frustrating trade of the world yesterday. That was the opening range, 724. We did 1600. So we did 2.25R to the downside. Didn't trigger the trailing stop and just closed out end of day basically where we opened, back at break even. So this one was a break even. The other three were losses yesterday. So I'm really hoping we get some nice clean movement, but as you'll see in the back tests in a minute, this is the norm. A breakout strategy is not going to work when the market doesn't break out with volume. It's just the way it is. If you want to trade the market which doesn't break out with volume, you need to be mean reverting the highs and the lows of the range. At those days where it does break out with volume, you'll get killed on that strategy. Doesn't matter what strategy you run. Every day, it either is going to be the right market for it or the wrong market for it. That's what we have to accept as traders. This is why we have to take losses. So just one of those frustrating weeks this week. But and this is what backtesting is all about. Letting you know that those things are going to happen. So that brings us on nicely after 23 minutes. That's probably a record for looking at the new ORB EA. So what I'm going to do first of all is I'm just going to run through the strategy. And bear with me a sec. Let me just check the code because I just want to check. Where's my MetaTrader? Where's my MetaEditor gone? Ah, locking up. Brilliant. Thanks for that. Bear with my computer. Spinning wheel of death. Just didn't open MetaEditor for some reason. Let me just open the data folder. I'll do it manually. Source. Open. Oh, Jesus. Right, that is the right version. Good. So basically, I just run through the strategy and what it does. So in the inputs, it's the normal Swiss Army knife EA, which has got all the targets and everything in it, all the trailing stop functionality, all the normal functionality we need to test everything. The way that I've got it set up is I'm testing a fixed lot size at the moment of 1 lot, just to keep results consistent. I'm using a martingale or a lot multiplier basically to see what impact lot multiplication has on it, because if it's got a high strike rate, that will actually help. If it hasn't, obviously it will blow accounts. So it's a case of seeing whether or not it's worth putting any lot multiplication in there. I'm testing what the fixed stop loss should be, and I'm testing what the fixed target should be, and indeed whether we should use a fixed target, which I didn't test, but I did actually do a test on that, and trying to go for those runners doesn't work. You're better off actually using a target, an R target on it. It works out at the end of the day. And I'm also testing what the minimum maximum range sizes should be, which is part of what we do in the SIH strategy. And I'm testing whether or not we should delete the pending order on the opposite side. So basically when the market opens, we place 2 pending orders, which is what the ORB strategy is. When we trigger that, should we delete that one or not? Yep. So when we close out, basically, should we get rid of that? And should we trade in the direction of the opening range candle? And this is to do with what that Swiss study said, that they did a variation of the strategy that only traded in the direction of the opening range candle. So if the opening range was bullish, you only go long. Yeah. If it's bearish, you only go short. If it's a doji, do what the hell you like. Or rather, yeah, doji. So that's basically the variables that I've tested. So the results basically, I'll just quickly run the test just to show you actually, so you can see what it's doing. That's in optimization mode. So this is testing the DAX. So this is going to trigger at 8 a.m. Let me just slow that down a minute. Oh, hang on. I've just recompiled that. Oh, no, that's right. Yeah. 8:05, 8:10, and 8:15. Not doing those. 10 and 30. Let me just check the settings are right. 10, 4, that'll do. 1.5, that'll do. We're not drawing the vertical line for some reason. That's the code I changed. Yeah, okay. Don't matter. Just a line. Right, let me just run this again. So what it's basically doing is at 8 o'clock, there, stop a minute. So there's the open at 8 o'clock. So that's your opening range. So it basically says, is that within the 10 to 30% of ADR range? If so, we'll trade it. Yeah. And then what it does is it waits until 8:10 and it looks at what's happened. If we've got a break, it will just go with the break. If we have had a break and we've stopped out, it will then adjust itself to use the 10-minute opening range, which is these 2 candles. So it will attempt to try the 10-minute opening range break. Now, obviously, if that had triggered an order and stopped out, the 10-minute ORB would be that big. Yeah. And it repeats the process. Have we taken a trade? Are we still in a trade? If we are in a trade long, we don't need to worry about it, but we will adjust the pending short order depending on what the 10-minute opening range is. Then if that one had stopped out, it would then go, right, we've now got the 15-minute opening range. So now we would attempt to take a 15-minute ORB. So basically what it's doing is it at the open, it's using the 5-minute ORB candle, and it's attempting to get a clean trade on and make profit. If it's achieved the clean break after 10 minutes, it goes, fine, we're in. If after 15 minutes, it goes, fine, we're in. Because essentially what we're doing is we're taking the 5, 10 and 15 minute opening ranges just with the first break, and we just go for it, and it will either work or it won't. If that trade stops out, it will then attempt to take the low break, which will be either the 5, the 10 or the 15, and it will take the break short. So what it's doing is it's saying, are we going to clean break today and make money, or are we going to false break out and then reverse? We'll attempt that one and make money. Yeah. If we do this, yeah, we're just going to take a couple of trades up to a maximum of 3, and we're done for the day because it ain't going anywhere. We've got no momentum. We've got no volume. We should have been a range bound trader today. So screw it, stuff it, move on to tomorrow. Yeah. So it takes a maximum of 3 trades. So the worst case scenario is you get 3 losses. Yeah. So I'll just run it through and we'll find an example where the ranges are actually workable. This is going to be way too fast, but why are none of these ranges working? There's one. We got one. Stop. So there you go. So this is the 5-minute ORB there. Okay, that's the 10-minute range there, and that's the 15-minute range there. So I went through it a bit quick, but basically that was too small. That was too small. So it took the 15-minute in this case. So we broke short, stopped out, and now we've broken long. Yeah, so the short break failed. Now we're going to break long. This is always got to be a minimum of 10% of the average daily range. The stop loss being used here is 10% of the average daily range as well. So as a worst case scenario, you should never get hedged, because unless it's exactly 10% of the ADR, the range, your stop loss will always be within the other pending order. And we can obviously also adjust this by putting an offset on it, but I'm not using offsets at the moment. I'm just looking for clear logic of breaks. So there we go. So that's now broken along. So as you can see up there, we've made a $17 loss because we had a loser, and another loss there. So 34. So that's it. Done for the day. We tried the 5, 10, 15 minute. The 5-minute was too small. The 10-minute was too small. The 15-minute was just about right, but we had a double stop out because it's just gone range bound. Okay, that's it. Let's go into tomorrow. So $34 loss, worst case scenario. Now, what you'll also see is that we are using a lot multiplication system. So that first entry there was a buy stop and a sell stop in there somewhere, but they were both placed at 1. Okay, so after that first trade stops out, if it's in the first 15 minutes, that will automatically go in at the lot multiplier. But because that was set at the same time as that and it flip-flopped around for a bit, they both got taken as 1s. So it's logged that there's a 1 loss. The next day, the next trade that we try is a 1.5. Yep, so we up the lots. Yeah, and then it just keeps going and going and going. So it will basically keep going with lot multiplication up to a maximum lot size that you can set. So what we don't want to do is get into that martingale scenario where you are suddenly blowing the account because the next lot going in is 350 lots, which is never going to work, is it? So my results actually show that even without any lot multiplication, it still is a very good variation on the strategy, but we'll look at that in a bit. So we'll whiz through some more and have a look. Just want to find some better examples. Okay, so no good, no good, no good. So these lines are red, meaning that the ranges are too small. Yep. So we're not taking any trades today. And if it's too small, you'll quite often always get hit. Now, if it's too small here, what we could do is move to the 30-minute range, okay? And that is an input in the EA, as well as the 60-minute, which I haven't tested yet. So when you get 3 failed entries at the 5, 10, 15, or you don't get trades at the 5, 10, 15 because the ranges are too small, we will look at the 30. So in this particular case, that is the 8, and that is the 830. So the range would have been that. and we would have broken long there. Unfortunately, that would have probably stopped out anyway. But look at it. If there's no volume at the open, there's not normally any volume. Yeah. So that one was no trades. Let's move on. Whoa, too fast. Way too fast. Okay, there's your 805, 815. Again, too small. Is this really set on 10% of ADR? 145. These ranges are terrible. I don't know. What period is this? January 2024. Market was dead. There's no volume at the open in January last year. This year's been totally the opposite, you know, but just want to try and find one that actually works. No volume again. We're in February now. I'm not going mad, am I? This is 8 o'clock on the DAX. Oh, you idiot. That's not the right time. That's 6 a.m. Ignore me. Right. Now let's try and trade the opening range, shall we? Put the wrong time in. I hope I didn't do that on the test. I've only tested the DAX. Obviously, everything else is 16:30 open. Sorry, there's my results. Oh my God. Okay, I'm going to have to retest the DAX. So 1635, 1640, and 1645. My DAX test. Well, that's interesting. So trading the 6 o'clock open actually produces a 6.6 return on drawdown. Go figure. Do you know what? I was looking at these figures, right, yesterday when I was doing the analysis and thinking, why is it you get 200 odd trades on the NASDAQ? You get 260 to 300 on the Dow. The SPY gives you 270 and 140. Why is the DAX only giving me 52 entries? And that, I spent about half an hour looking at this yesterday going, why has the DAX not got any volume at the open? Because I've got the wrong bloody time in it. I'll redo that test. So we'll ignore the DAX today and we'll do the test on the US indices. This is going to be interesting. I will get a proper result on the DAX now. I thought the DAX was really like that. Well, that's way too good to be true, but it's not taking any trades. Is the stop loss an ADR multiple? Yeah. ADR multiple. So the reason this analysis came about was because of this document, which is the Swiss Financial Institute's analysis into the opening range. And they tested lots of different variations, and they finalized, or they came to the conclusion that using 10% of the average daily range is the optimal stop distance for an open when you get a volume open. So 10% of ADR as a fixed stop. I have tested all the different variables. Look, so I've tested the ATR stop from 0.1 to 0.2. Basically, if your stop loss is 20% of the average daily range, you're looking for a 60 to 80% move to get a 3R return. That's hard. That's quite hard to achieve. Also, a 20% stop loss takes it outside the range. So the whole idea is we don't want to hedge. I've got a stock index hedge EA, does that. We don't want to hedge. We want a stop loss based strategy to try and get an edge using stops. So it's got to be within the opening range size. So the test was 2 hours early and still profitable. But this is the thing, it doesn't take many trades. That's the thing. Look, 50 trades. Let me just turn the filters off. 0.1s, 0.3. minimum max ranges. So that makes sense now. Yeah, look, I was at like 181 was the maximum number of trades we got. And then we got 300s and 200s down here. But that was only because we were saying don't bother about a minimum range. Of course, the market's not going to move very far. So when you start reducing the minimum range that you have to trade, yes, you are going to get more trades. But, you know, and the return on drawdown still worked. The only reason it works is because I've got a positive R. It's always going to work with a positive R. But the stop loss is 0.2. So the stop loss is 4 times the range. So what we're saying is take a trade in both directions before the market opens, use a whacking great stop loss, and if the market moves more than 0.2 ADR, we're going to make money. You can't not really make money. You're not going to make a fortune with it. And it's going to have a massively low strike rate, but it will work. You're hedging virtually every time, basically. It all makes total sense to me now I've seen that. So anyway, so this is the proper opening range. So now we're going to get some trades. Here we go. Right. So clean break short. Yeah. So we took the 5-minute opening range. Let me just pause. Yeah. So that is your 5-minute candle, your 5-minute ORB. This candle here. And as you can see, we placed a pending order at the highs. We placed a pending order at the lows. We triggered immediately on the 10-minute candle, the 15-minute candle. Yeah. And then pop straight down to target. We've left that trade there. So that buy stop is still in place. There is an option to test whether when we close that in profit and bank that $73, should we remove this? Now, there's lots of different variations on it. But if you have a very small target, a 2R or a 1R target on that, there is a high probability that it's going to do this, in which case then you do want to take that because you've got an opportunity at taking 2 profits. If you're using something like a 3 to 4R target, the chances of it getting all the way back there within an hour and a half is quite low, which means that this is your high of session, because there is a 90% statistic on probabilities of 1 hour and a half into a session, the high or the low is already formed. So you won't get back here. So this doesn't trigger very often. You'll see as we go through testing, it very rarely triggers the opposite side, unless that is a false breakout and doesn't go to target, in which case then it will trigger the other side. So we'll whiz through. We'll try and find some examples of 5, 10, and 15s which work differently. Trying not to go too fast. Okay, right, so in this case, there's your 5-minute ORB. So again, we've taken the 5-minute ORB there, okay, placed our pending orders. We have triggered short on the 10-minute candle, yeah. And now there's your 15-minute range painted in. So what the EA's done is it's, as you can see up here, it's deleting the pending orders every 5-minute candle and replacing them at the high of the 5, the 10, or the 15-minute ORB. So the 15-minute range is now what we're taking. Now in this case, obviously the 5, the 10, and the 15 are all the same level. So it just deletes the order and replaces it. But it's just to make sure that we get that range correct every single time. And also we need to do the calculation on the range. So we're short at the moment, so we'll just let this play out a little bit and see where it goes. Okay, so that stopped out. Yeah, and now it's going back down again. And now we've triggered long and stopped out on the long. That's it, done for the day. 2 losses, that's it, move on. So that's all it's going to do. Now you've got the option, obviously, now of saying, okay, well, let's now take the 30-minute ORB. So the 30-minute ORB would trigger on that candle there. So that would be your 30-minute ORB, but that would have been the same long as the 5-minute, 10-minute, and 15-minute ORB, so there would be no difference. That trade still would have been taken on a 30-minute ORB. That failed, so you had the option then of going in on you would actually have a line down here now on the 60-minute ORB, which would be triggered there. So the 60-minute ORB would have replaced that order after this one stopped out and placed a pending short here. So that's your 60-minute opening range, which is what they call the initial balance. That would be an initial balance breakout long. That trade would have worked. Yeah. So your 10% stop loss would have been there, and your target would have been there. So we'll see if that manages to get to target on an hourly ORB, which is the initial balance break. No, that would have stopped out. So that would have been a third loss on the day. Yeah. Again, I haven't tested on anything beyond the 15 yet, but that is on my list to do as a what to do next sort of scenario. Anything above an hour, you don't want to bother with, because if it hasn't done it within an hour, it's not going to do it unless there's a news event. Yeah. So we'll move on and do one more. Eight, 9, 10. There we go. So there's our 5-minute ORB there. So as you can see, pending orders placed long and short, triggered on the long. Yeah. That's our 10-minute opening range there. That's our 15-minute opening range there. As you can see, the line is green, which means it's within target. In protocol, it's within 10% to 20% of the opening range. It would be painted red if it was exceeding or lower than what we want. That one's clean broken long. Come back down again. Stopped out. Okay, so we're now stopped out on our long. So it's a failed breakout to the upside. So now we're looking for a breakout to the downside, which we've achieved. Stop loss is still intact. Now, this is where adding a trailing stop may well have an advantage, which is the next part of the testing. Okay, now we've stopped out. Hit target. So there's a TP of 33. So you can see it's up $59. We're only trading one lot, so it's a 37 or whatever. But obviously with the trade that was taken there, you can see the lot sizes obviously are a lot bigger. So this 2.25 here. So we're recouping our losses using slight martingale with this at the moment. I'm just using the 1.5 as an example. But that's basically how the logic works. So it's very similar to the original ORB strategy, but it's incorporating the dynamic sizing from SIH basically. So it's a kind of a hybrid between the two. So we've got a clean long break there, hasn't got to target yet. It's just mucking about. Back inside the opening range, stopped out, flipped short. Stopped out, I'd imagine. Doesn't look like it's going anywhere, does it? So it's a rotation day. You can't do anything with it. You cannot make money as a momentum breakout trader when it does that. Yeah, so that one was a loss. Clean break short after the long stopped out. Missed target by probably 2 pips, 3 pips. There we go, hit target. So that's a nice clean one. Now look at the profit on this. $162. That's because it's using lot multiplication. So we haven't had a very good run, but we've made money because we are ever so slightly increasing that lot size, because the strike rate of the strategy is around about, I haven't actually looked yet because I haven't run a proper test. In fact, let's run this one and just see what the strike rate is. Should be somewhere in the region of 35%. Actually lower than that. Look at that. 24% strike rate. So it didn't make money, this variation. I mean, there's no reason why it should. I'm not specifically testing to make money. I'm testing for functionality. But God knows what that was. That'll be the martingale. That'll be the lot. So that's hit the max lots, which is 20. And it couldn't get there. So yeah, I mean, this is the downside of using lot multiplication, obviously. So yeah, so there you go. So that's basically how it works. If we hadn't have had that blip where we obviously went into a horrible range for ages and ages and ages, and you tag that equity curve onto the back of that bit, very nice. Now that's what we need to deal with. So that's where lot multiplication comes in, and this is why I've done all the system permutation testing, which I will show you now. But I will not use the DAX because I did the wrong test. Again, flip a coin and position trade it, sort of. I don't know what you're talking about there, but I don't know. No, not on this. Not on this. Why are the lines not at the 5-minute opening candle? Which ones? These lines. This is because this is at the 4:30 candle. This is the New York Open. I forgot I didn't code in the 8 o'clock open. But the line, if you mean the lines here, these are repainted every time. So it will paint on the 5-minute, then it will paint on the 10-minute, then it will paint on the 15-minute. In testing, it goes too fast. So I'm not going to leave all the lines in place because it just makes a mess. But it's just to know so I can see visually where the breaks are and where the lines are. But it will always be the 15-minute left in place. If we use the 30-minute, it will be the 30-minute left in place. So if I make that 10:30, and then we go with a 11, which will be the hourly, and we rerun that, you'll see that the lines are now painted on the opening range high and low of the 1 hour. So there's your 5, 10, 15, 30, 1 hour. So the lines just moved to the very last range that you are attempting to trade. See, and there's your hourly one, which failed as well. But you know, that could have worked. I'm up 300. Look, let's run that. I'm interested just to see what this does with a 30 and an hourly profit wise. Wow, massive difference. Bloody hell. Strike rate 26%. Still bad, but 1.49 profit factor. There we go. Difference between adjusting 2 inputs in an EA. Equity curve that looks like that. That's in a year. Using one standard lot. Not exactly using a lot of risk either. So it's taken $1,000's worth of drawdown to make $7 grand. Let's put some proper risk on this, shall we? I'm interested. So I'm just thinking prop. What have we got? $5 grand to play with. Stagnation there, look. No difference. Oh yeah, there is. No, 19 grand off of a $4 grand drawdown. So it's a 4 return on drawdown ratio. 7% drawdown to make 20. So if you're using a 100 grand account, sorry, a 50 grand account, depending on who you're trading with and everything, but $5 grand drawdown is equivalent to 10% of a 50k account. If you're running a 50k prop account in the year, that would have produced 20 grand in profit. Would never have hit the drawdown. On a 10 grand account, you can double that to 40 with it and be safe. That's just on the DAX. Forget the NAS, the S&P, and the Dow. Obviously, you could forex that. But it's a long-term edge. Look at the equity curve. You're going to get periods where you're just going to sit there and you're not going to get paid. You're just not going to get paid. This is what it is. But when the market is volatile, we make money. When the market isn't volatile, you don't make money. When it's volatile, you make money. Not volatile. Volatile, 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 a little bit volatile. Not volatile at all. In fact, just hardly ever moving. Now it goes back into volatility. Yeah, it's long-term edge. It's not about making money every day or every week. Anyway, I'll save that set file for future reference. Now I've done the test properly. I've got to rerun these 1700 tests on the DAX. So is the lot multiplication per trade or range break or per day? So the way it's working at the moment, and I don't know if this is optimal yet, is on the 5-minute ORB, we place a pending long and a pending short with one lot. If nothing has happened, on the 10-minute, we delete those and we place them again. On the 15, if nothing's happened, we delete them and we place them again. And then a trade gets taken, and either that makes a profit, in which case the next day we use the same lot size, or it stops out, in which case the next day we use a 1.5 or 1.3, whatever your multiplier is, you multiply. If when you go on the 5-minute break, you go straight in on the open and it immediately within that 5-minute candle stops you out, it will delete the pending orders at the 10-minute mark and place new orders. Because you've had a stop out, these will be multiplied. Yeah, if you get a 10-minute breakout and then it sits around for 20 minutes and stops you out, you have a stop out at 1.5. The 15-minute range isn't traded because you've traded the 10. The 15's gone, hasn't done anything, you just carry on. So the next day, you start with a lot multiple of 1.5 plus your multiplier, or whatever the multiplier has become, the lot size, it multiplies again. So basically what it's doing is every time it places a trade, it will multiply based on whether the last trade was a winner or a loser. Yeah. The only way this loss recovery, and this is true of all loss recovery systems, the only way loss recovery systems break down is if you have an instance where let's say, for example, you had a losing run of 6 or 7 trades and you've got quite a large lot size on. If it happens to be this is the lot size that breaks, your target is there, and it does this, and it closes out in profit of like 4 pips. That's a profit. So the system goes, well done, you've made a profit with your massive lot size. Tomorrow we're going to move back to 1. But what you've actually done is not recovered any loss. Yeah, this EA will auto close at end of session. Yeah, we're flat end of day. You never hold overnight on the indices. It's flat end of day. That's it. So that's the only case, only instance where the loss recovery mechanism would fail. You know, and these test results, look, this is the martingale factor. I'm not being funny, but look at the top results here. This has got a 10.5 on the NAS, 10.5 return on drawdown. Look at the martingale factor, 1.2. We're not using it. We're ever so slightly. This one does not use any lot multiplication at all and gives you a 9.5 return on drawdown. Yeah. 1.4. And my testing shows that what happens with a lot multiplier is you get a better return on drawdown, but you get a much higher drawdown. So it's all about risk. It's exactly the same as every system or strategy in trading. The more money you put on, the more drawdown you'll take if you go wrong, but the more you'll make if you get it right. So if you don't use any lot multiplication, if I drop this down to 1, so we're not using lot multiplication, we've still got profit factors here and return on drawdowns of 9s, 7s, 6s, 5s, 4s, 3s. We keep going, 2s, 1s. Yeah, we get down to 1, which means that worst case scenario, yeah, you break even. This is not losing any money. Yeah, there's 1,000 scenarios here that do not lose money not using lot multiplication. It's about long-term edge. The market, as long as you're using a positive R, stop loss at 0.1, TP at 0.5, so I'm using a 10% stop and a 50% of range target, you will make money if the market breaks. Yeah, you're going to make 5 times more money if the market breaks than you lose. What does that mean? If you've got anything above a 20% strike rate on the strategy, you cannot not make money. It's impossible not to make money. All we need is 20% strike rate. But we need the market to be volatile enough to move to 5R. A lot of the time, it won't be, and it will get to 3 or 4. And this is where it starts to increase strike rate, and you get fairly decent return on drawdowns. So if you suddenly then go, okay, I'm going to use a 2, proper martingale, which is 2, yeah, look at the profits, 15 grand, 25 grand, and we're up in the big high return on drawdowns. But we had big high return on drawdowns not using this. The difference is we got massive drawdown on the account, but we're making, not massive, but we're making massive money. Yeah, because we're taking massive risk. Yeah, you could have 20 lots on. Start with one, you could have 20 on. I don't know, we'd have to test that. This is what it's all about. Once you've got the parameter permutation test, you can see what does and doesn't affect profitability, doesn't affect drawdown, doesn't affect strike rate. You can then whittle it down to, well, there's no point in looking at that. There's no point in looking at that. Let's focus on these bits and find a happy medium where you've got a return on drawdown that isn't the top one, isn't the bottom one. It's somewhere in between, because this is going to have a high probability of repeating itself if it's in the middle of your results, not at the ends of your results. If you jump straight in and go, I'm going to take the top one, out of 17,000, you have a 1 in 17,000 chance of that happening again. 1 in 17,000. Do you think that's going to happen next year? It's not going to happen next year. Something will happen next year, and it might be somewhere in profit, but it isn't going to be that. It could be 20. We don't know. We've no idea. You can't predict the future. But it tells us that if you use low martingale factors or low lot multiplication factors, but you keep your risk reward at 5R, and you make sure that we've had a volatile open. So again, going back to that study, this column here, going back to that study from the Swiss Financial Institute, they were using a measurement of opening range volatility. So they needed the opening range volatility or volume to be higher than average volume over a period of 10 days, 14 days to be able to take a trade. What this range minimum range multiplier does is it says the opening range candle that we're trading has to be at least 20% of the average daily range. To achieve 20% of the average daily range at the open, you have to have volume. So this is my alternate indicator, if you like, to measure relative opening volume, which is what they used. So having a larger minimum range means that we have to have volume to achieve the range most of the time. You can get slippage on low volume, which does the same thing, but it's a lot less likely at the opening bell, obviously. So so this kind of is the equivalent of that average minimum volume reading. So it does prove their theory that if you use 10 to 20% as the minimum at the open, it means we've got volume. If we've got volume, we've got high probability of a volume breakout happening. So you don't have to use massive lots, because if that is happening, you've got a chance of a breakout. If you only get a 0.05 or a half of like 5% or 10% of the average daily range at the open, yeah, it's probably not going to have much volume to do the open, because it's not there, is it? So therefore, using a lower size of open, usually you will have a higher martingale factor, which isn't actually the case in this particular one. But that would using a higher lot multiplication would outweigh the ones that don't work, and make sure that the ones that do work have more size on them, basically. So when you get chopped, you make sure that the next time you don't get chopped, you've got a big one on to make the money back, which is how loss recovery systems in trading work. So going through these results, basically, obviously we've got martingale factor, as I've called it, which is lot multiplication. I should change that. I hate the word martingale because it's not martingale. You got your stop loss as a percentage of ADR. You've got your TP as a percentage of ADR. You've got your minimum size of range, which is either it basically ranges from 5% to 20% of the range. You've got your maximum range, which ranges from 20% to 40% of the average daily range. Whether or not we should delete pending orders after we have taken a profit, and shall we let those go? Yeah, so the other trades in the opposite direction, shall we have a go at those as well? And then we've got your trade direction. Should we trade in the direction of the open or not? Yeah. Euro's moving a bit, is it? Let's have a quick look. Aussie New Zealand's hit ADR. So we've got to move on the Aussie. Euro coming down. Yeah. So this is probably selling into the open. Oh, that's German GDP. A lot worse than expected. Lagarde did forecast this, and so did the Chancellor of Germany. Also forecast that to drop yesterday. So yeah, bad numbers for euro. Spanish CPI was up. We don't care about the Spanish. Not that we don't care about the Spanish. It's just that they don't contribute much to the economy. So, yeah. So basically, those are the test criteria. So I was joking about you talking about to use the right target and a wide stop, let the price wiggle around. Oh, I see. Okay, right. I get you. Talking about position trader. Yeah. It does work, though. This is the thing. I've just proven by accident that does work as well. Everything works if you give it a chance. This is the thing. This is the whole system hopping thing that I keep going on about. Everybody goes, I'm going to trade that. Oh, it doesn't work. It does work. You just need to let it work. It's not going to go like this. It's going to go like this. On its way to getting you to profit. It's going to be ups and downs all the time. People just don't let edges play out. That's a problem. Lots of them out there. There's millions of edges out there, but no one lets them play out. It's just maths. So, looking at these, trade direction. Okay, so you can see that these results here, we're going to concentrate on the NASDAQ. Might as well pick one, NAS, S&P, Dow. I've also tested on gold. Not bad results, not great, but not bad either, because the gold moves at the open. But the drawdown is... actually, it's not too bad, but it's not quite as good a return on drawdown on gold, because you've actually got two factors at play. You've got gold, which is opening in the futures market, and you've got US dollar. So the difference between gold and something like the NAS, the Dow, and the S&P is you've got single instruments rather than duplicate double instruments. But it does work. But anyway, we'll concentrate on NAS. So trading in the direction of the open. So this is basically, if the candle is green, we only go long. If the candle is red, we only go short. I was skeptical about this, always have been, because the initial balance, or the initial cash balance, or the opening range, whatever you want to call it, the first batch of orders that goes in is not directional or speculative play. It is bank and institutional. Get these orders off my desk so I can get on with my day. Whether the candle is green or red is purely down to the imbalance between bank and institutional orders at the opening bell. It has nothing to do with where we're going today. Yeah, it's a 50-50 shot, whether it's green or red, depending on how many orders these guys have got placed on their desk between 1:30 yesterday, or rather 4:30 yesterday, and 9:30 this morning. That's it. So overnight, orders have accumulated. Let's get more executed. I don't see how that has any bearing. And my testing proves it. All of these top results, these top 34 you can see on the screen here, or 33, all say do not trade in the direction of the open. Yeah. And as we scroll down, these all say do not trade in the direction of the open. These say do not trade in the direction of the open. The first ones that you have down here that say do trade in the direction of the open, yeah, suddenly the drawdown doubles. However, the profit goes up dramatically as well, but you got much better return on drawdowns up there. So, you know, this is the first time here and here you can see that it says, yeah, actually we should be trading in the direction of the open. What that does is it halves the number of trades that you take, but you get twice as much drawdown, i.e. you get twice as many wrong, because you're saying, hey, let's go green. When it goes green, it really goes green. But when it goes red, we just lose. But we lose more often because this has got no bearing on direction of price movement. Who gives a monkeys what the first 5 minutes orders are? It's irrelevant. I want to know what the rest of the day is going to be. We're trading a breakout of intraday momentum. It doesn't matter what happens in the first 5 minutes. So this doesn't make any difference. Yeah, go down. Look, they're virtually all zeros. The odd ones creeping in every now and again. So what I decided to do was turn that filter off. Doesn't matter. We don't care about trade direction. And this is also true on the Dow. It's true on the S&P. It's true on gold. It's true on the DAX, although not as much, but now I know why. So yeah, that's the other thing that confused me yesterday. I was like, why is the DAX so directional on the 5-minute open? It's not, because I was trading at 6 o'clock. Anyway, we can laugh about that one later. Whether we should delete pending orders. So basically what this is saying, right, we're going to go long, we break long, that one works out, excellent, we've made money. Should we get rid of this? Highly likely we're not going to hit that, because if we've managed to get to TP, we're not going to hit it. Yeah. So, and if we stop out on this order and make a loss, we want to get that on. So it seems that there is no reason when you place your pendings to actually close that pending off. I thought it would be a good idea so that we didn't accidentally take a loss on a break in the other direction. But when you think about it, if you do get the win, the chances of getting back there are minimal. So whether you delete it or not probably doesn't actually factor in, because it doesn't become part of the strategy, because it never actually gets triggered. And if it does get triggered, you've probably got a news day. We'll take the second profit, please, if the news reverses the entire day's movement. So deleting the pending order is very mixed bag. Lots of ones, lots of zeros scattered throughout the whole of the top range of results, telling me that it doesn't really make an awful lot of difference. So when I get a result like this, where we've got lots of ones, noughts, ones, noughts, ones, noughts, ones, noughts, and it's telling me there's no conclusive yes we should or no we shouldn't be doing something, I tend to leave it as it is and then filter out other columns. So the next bit I wanted to look at was minimum and maximum ranges. So this is the size of the range. It has to be at least X and no more than Y. Yeah. So if we open here in the 5, 10, 15, and it's way less than 10% of the range, the chances are we've got no volume. We're just going to move up and down. If we're going to move up and down, we're just going to get stopped out over and over again. So we need it to have some volume, basically. Again, this is my equivalent of relative volume, average relative volume over a period of opens. So that's basically the kind of substitute indicator that we can use in everything. Range multiplier here is at 0.2 and it's a clear winner. Look, yeah. So the open on the Nasdaq needs to be at least 20% of the average daily range, and all of these are 0.4s. So if you've got an opening range between 20 to 40% of the normal daily range, that is optimum for the Nasdaq. If you go further down, you see creeping in here some 0.05s. But the vast majority of them are 2s. Then we start getting down to 1s, which is 10% down here at 4.89. And then we get more 0.15s, 0.5s, etc., etc. And then it becomes very, very mixed. So it would say to me that these really are outliers, and these produce phenomenal results. 6 to 10 return on drawdown. 6. Anything above a 4, you've got a strategy which is bulletproof, pretty much. 6 to 10s are very special. You don't get 6 to 10 return on drawdown. It's a very, very, very high. And I'm always looking at these thinking something's not right, because you don't come across this very often. This is a very well-known strategy, obviously, and very documented. So, you know, if it's very documented, very well-known, it's because it works. Yeah. So these are outliers. So I filtered down to just use 0.2s. So 20% of the average daily range. And you'll see the difference between, let's say, a 10 and a 20. I'm going to filter those two. So we've only got 10s and 20s. The 2s, which are all the 20s, give you roughly 200 odd trades a year. When you start going to the 1s, you suddenly double. We've got 400 trades, 400 trades, 395 trades, 391. 359. Yeah. So the difference between using a 10 and a 20% range is the number of entries you're going to have each year. Obviously, to move 20% of the average daily range at the open takes a hell of a lot of volume. The thing that worries me about that is if we've done a hell of a lot of volume, we tend to get quite a lot of stagnation moving in from there. So that really is the only thing that gets affected. You can see the return on drawdowns here are all 4s, 5s, 6s, 7s, 8s, but all of the big ones are at the top, which are 0.2s. But as you go down, you've got a real mixed bag in here. So this kind of, for me, becomes a preference. Do you want to take less trades? Yeah. Or do you want to take more trades? So the itchy trigger finger people, 10%. The not so itchy trigger finger people, 20%. But you're all going to get roughly the same return on drawdown, whichever one you pick, just through the laws of averages of volume being there or not being there. It's just you're going to have less opportunities if you use a wider range. So I don't think that really makes any difference. I wanted to identify if there was a advantage to using 0.5, like 0.5%, or 15% of the average daily range. And when you go down to the 0.5s, which are really, really tight ranges, you do actually get very good return on drawdowns. But the problem with using this is if we're using a 10 or more % of ADR as a stop loss, you are going to get hedged, because if you're using a range of 5% of the daily range, placing pending orders there and there, your stop losses are 10% of ADR, you can trigger into a hedge. Anybody that's in the US using FIFO rules cannot do that. So I wanted to look at a strategy that works for everybody, which means that if you remove that out of the equation and replace it with a 0.1, which is 10% of the average daily range, you get roughly the same return on drawdown, taking roughly the same amount of trades, but you will never get caught in a hedge or using FIFO. So the 0.5s became irrelevant. Then I looked at the 0.1s, the 0.15s, and the 0.2s, and you can see there's a 0.15, 0.15s, 0.15s, 0.15s. They're spread all over the place. So it doesn't matter what your minimum range is. You can use 10%, 15%, 20%. All that's going to happen is you're going to either take slightly more or less trades every year, but the profitability is not affected by minimum range size. So because I know my previous testing told me to use 10% as the optimum, that's what I decided to go with. So I'm going to stick with 10% of minimum range. Because I'm using 3 ranges, if the first one's too small, I get a crack at it on the 10. If the 10's too small, I get a crack at it on the 15. So we're just basically meaning we're going to get a trade on pretty much every day. Because if the 15-minute opening range is less than 10%, we want to run a mile. It ain't moving, is it? So you don't want to trade it. So I'm going to stick with a 10 because it doesn't make a lot of difference. The maximum range size, but you can see what is missing now. Yeah, we start at 4 as a return on drawdown. What we've just lost is all of these juicy 10 or whatever ranges. So these massive return on drawdowns with these, I think, are probably outliers. They may not be, I don't know, but this is something that I would do a out of sample test on to see, you know, it may be better we just take less trades and whack a hell of a lot more risk on each one and go for those massive home runs on these 20%ers. But I need to see what the strike rate is on them. So either of those really is going to work. Then let me just move it back down to the 10s because that's what I'm going to focus on. Maximum range, I tested from 20 to 40%. So if we're using a 10, you've got to be above a 10 for the maximum. So we start at 20 as the logical place and up to 40. If it's done more than 40% of its average daily range at the open, it's done everything. It's out. You've run out of gas. It ain't going anywhere. And if it does go somewhere, fine. But it's more likely going to struggle to make any more movement, and using a 10% ADR stop, you're going to get stopped out a lot. So it didn't make sense to go above 40. I tested above 40, I tested 50 up to 100, and it just confirmed that there's just no point. It just doesn't do anything. It has no effect on the strategy. So 30 to 40% of the range, as you can see, there's 3s and 4s everywhere. It makes absolutely no difference. What we're saying is you've got to have moved 10%, whatever the upside is, as long as it's not above 40%, which means we're going to exhaust ourselves, we just take the break. Yeah. So it doesn't matter which of those you use. They will both give you nice return on drawdowns. So I decided to just stick with a 4 because got to pick something. You've got to have something in an EA. It has to have rules. So I've gone 10 to 4. So I'm using quite a wide range. If I use a 3, you can see my 4.89 down to 2.63 there. Changes from 4.71 to 2.4. There's just no difference. It doesn't matter. Pick one. Yeah. So I decided to go with 4. Just for no other reason than it's bigger. Delete pending orders is now completely mixed. 1s and 0s. Yeah. There is no advantage to deleting that opposite side of order at all. Doesn't make any difference. So I decided not to delete the opposite side of the order because I might as well just take it. If it doesn't work out, or if it does work out and then we get a news event that goes the other way, it makes very little difference to your profitability. Yeah. And then we start looking at ATR, TPs and stop losses, and 20% and 10% are the ones which kind of stick out the most in here. But the TPs are very clearly 0.3s and 0.4s. So what it's saying is you do not want to target anything less than anything more than 30 to 40% of the average daily range, which makes sense. If we're taking a trade at 10%, we go to 40%. We've moved 50% of our average daily range in one direction. Likelihood is it might turn around or at least pull back, and it might get, we know 58% of the time it stays within ADR, it might get a bit further. But if you try and go for those big home runs, they don't work. So keeping your TPs fairly nice and small makes sense. So I decided to go with I think I went with a 0.3, something like that, yeah. Stop loss at 0.1 or 0.2 or 0.15. Don't really mind. It's somewhere in that range. So it's going to give us a return on drawdown of somewhere between 1 to 4%. So that's what I was going to kind of stick with. The martingale factor, as you can see, it doesn't matter whether you use 1, 1.2, 1.4, 1.6, 1.8 or 2. All that does is affect your drawdown. The 2 is 6.58, the 1.8 is 5.48, the 1.6 is 382, the 1.4 is 2.3, the 1.2, 138, and the 1 is 98. All martingale does is increase your drawdown and increase your profit accordingly, giving you roughly the same return on drawdown. Yeah, so it doesn't make any difference whether you lot multiply or not. The advantage of lot multiplication is smoother equity curve, less jagged. That's the only advantage. But more drawdown, more risky for people. Yeah, so it's something that is a personal preference. I think somewhere around about a 1.2 to 1.4, which is what I've always used in position trading, will work. But if you don't want to use it, don't use it. Doesn't make any difference. Yeah, it will still be edge. There'll still be edge there. So there's lots and lots and lots of variations in there that can work out. And I need to do some further testing on it. Now I know what affects and what doesn't affect profitability, so I can scrap that and scrap that. I don't need to worry about that. Maximum range, I can scrap that. We'll set it at 0.4. It doesn't matter what the upside range is. It very rarely goes above 20% of your average daily range. Yeah, if you look at back at the opening range breakout that I do every day, yeah, to get a 20% of ADR in one candle at the open, it's so rare. And anything more than that is even rarer. So we're not really worried about using that, I don't think, as a measurement. So that I think I can scrap. So the next testing will be screw the opening direction, screw deleting the pending orders, screw the maximum range. I'm going to stick with a 0.1. I am going to test variance on that. And I'm going to start retesting using these variables with a trailing stop to see if there is another edge there. So these will all be, again, retested. And so my tests will look along those sorts of lines. I may test using a minimum 20, which will half the number of trades, and see if a trailing stop will actually maintain these figures, which are much higher return on drawdowns. So it does make sense to use a wider range, but you will get less trades on. But it seems to me that that is what really kicks this return and drawdown up to these lofty levels. But running a system parameter permutation or rather an out of sample test using this, I reckon these won't produce the same results. In fact, let's run that and have a quick look just out of interest. Out of sample, and just see what that does. So let's go 2022 to 2023. We need to adjust all our times. So it'll be 16s, 16:35. Uh, 16:40, 45, and we can use a 0.2 out of sample and a 0.4, and we are going to adjust our close time to 23. So we're going to close at end of day. 0.1 stop, 0.4 TP is fine, and lot multiplier 1.4. So just pick one, doesn't really matter. I'm going to switch that back to one lot just to give it a comparable test. So let's just run this and just see what the equity curve looks like on this one. So this is testing the bigger range. That gives us 9 grand for 3 grand of drawdown. So that's a 1.34, which is equivalent to roughly 5. So let's rerun that with a 10% range as a minimum. And see if we get I would expect a worse profit factor. $1.23, yeah. So it is pointing out. This is an out of sample test. So this is data that the test, the initial opening, the initial system parameter permutation test has never seen. So this is a 2-year out of sample test on that year of optimization. Results are obviously positive. 23% strike rate, so it's maintaining the strike rate around about 25%, and it confirms the results that we got in the initial permutation test, which is you do actually want to be using a wider range, 20%. Interesting. Obviously this is going to be specific to the NAS. Now if we rerun this on the Dow, you can see on the Dow there are no 0.2s in there. There's a couple that creep in, but on the Dow you want to use a smaller range. So the other thing that this new version has pointed out to me, which is interesting, is that they are very unique. We know they're very unique in their movement. All the indices have a slightly different movement because they've got different number of stocks in them and they've got different sectors in them. So obviously the NASDAQ is tech sector. Tech's hot. Tech moves all the time. Therefore, it's got more volume at the open, more range at the open. So using a wider open will confirm more volume, which will give you a faster, stronger breakout. On the Dow, however, it's motor stocks mainly. So, the DAX, however, it's motor stocks mainly. So, and industrial in the Dow. So you've got less stocks involved, which means you get less volume because there's less traded. So therefore, you want to use a smaller range to identify volume at the open. So the Dow, we actually want to be using a 0.1. Yeah, and this isn't something I factored in or tested at all when I was developing SIH. So it may be the case that what we need to do is use different minimum maximum opening ranges on the Dow to the ones that we use on the NASDAQ, because they look like they move very similarly at the open, but actually the volume and the movement is very different. So this is, again, I'm testing these all individually, and then I will do all individual out of sample tests on them to verify the results, which is what you have to do. But the TPs and the stop losses and the fact that martingale makes very little difference is all very much the same across all of these. You know, whether or not you use the direction of the open. Interestingly, the Dow doesn't perform anywhere near as well as the NASDAQ. So it may be that there's more testing to do on this to try and produce better results. Or it might be that because the Dow is industrial stocks, it's just not as good at the momentum open. So what we might need to do on the Dow is say, okay, let's screw that. Let's take the 15-minute, the 30 and the hour. And we'll test the initial balance, which is the 60-minute open, and see if that has an edge. And on the Dow, we'll just trade the initial balance edge. Same with the S&P. S&P gives very similar results to the NASDAQ. 0.15s and 0.2s, indicating that we need a wider range at the open to make a higher return on drawdown. Doesn't matter which way you go. Doesn't matter if you delete the pendings or not. Range can be as maximum or minimum as you want. Stop loss somewhere between 1 to 0.15 ADR, and TPs 4 or 5 or 3, and it doesn't matter which you use. So this S&P and the NAS, you're going to get very similar statistics on. Gold is a little bit different. Needs more testing, and it's not something I trade, so I need to delve into it more. But somebody said to me, why don't you trade gold on futures? And I said, because I don't trade gold. And he pointed out the fact that gold has explosive moves at the open, which it does. If you go and look at a gold chart, and it's not something I've ever looked at in any detail, but if you look at gold at the open, there, yeah, it does move on the opening bell. It's a commodity. It's a futures commodity. It is traded on the futures markets. Yeah, so there's the open there. So you see we get, obviously had a run up beforehand, but this is the thing. Gold moves also because of the US dollar. So although it does move at the open, yeah, it also moves all day long, which is the thing that's always put me off of trying to trade a specific time range on it. But it actually does move at the open. But if you look at the results, the return on drawdown is somewhere between 2 to 4 as opposed to 6 to 10. So while it still has the edge isn't as defined. And obviously one lot on this produces 23 grand of drawdown and 90 grand of profit. So obviously you need to adjust your lot sizing, because a single lot on gold is a very different thing to a single lot on the NASDAQ. And DAX, obviously I need to retest. But I found a very interesting edge before the DAX opens here. However, I'm not sure how you trade it, because I don't actually have that time. Oh, yeah, I do have that time on the DAX. So it's trading this basically. Which in effect is trading that. So it's trading what happens in the run up to pre-market, which is the 7 o'clock. So the pre-market is taken from 7 a.m. This is where the pre-market is taken from. So the DAX exchange opens 1 hour for electronic trading before the bell rings. So this is where the bell rings, but electronic trading is actually conducted from 7 a.m. in the DAX, which is why I have the pre-market range. This is not real. This is broker data. So I was trading the pre-market. So it's taking the pre-market break, basically. Interesting edge. I didn't even know it was an edge. Now I do. It's got a bloody big edge as well, look. 4 to 7. So that might be worth investigating. But I need to rerun all this on a proper. I'm just going to change that, the name of that one to DAX 6 to 8 a.m. Just so that I know which it is, because that's a totally different strategy. But it's got a very nice edge. But it does require martingale to be or lot multiplication to be fairly high to achieve the result. But it's still very good, isn't it? Anyway, some of the best systems in the world you stumble across by accident. But it doesn't take many trades, look, 50 trades. Yeah, it just doesn't. Yeah, you're not going to get a 10% minimum movement of ADR before the thing opens, are you? And if there's a reason. That's probably why it works, because if you've managed to get a 10% average daily range before the pre-market, before the electronic open, first of all, you've got to have a broker that trades that or shows that data. You've got a high probability of when the electronic exchange opens and those initial orders go in of making a nice break. But the chances of getting 10% of your daily range done before they are even allowed to trade it seems to be in a bit of an anomaly, which is why you got 50 trades a year. So it's one trade a week. Once a week, it manages to find an edge. Edge is an edge, isn't it? 600. If somebody said, give me 600 quid and I'll give you back 4, would you take their money? Someone said, give me 6 grand and I'll give you 40 grand. You'd think, yeah, I'll take your money for 1 day a week. It's not a bad pay, is it? 1 day a week, 40 grand. Anyway, we'll see. I'll work on that bit. But yeah, so there's a lot more testing to do on this yet. And a lot more verification work to do, which I will be working on. But this variation I like because of 2 reasons. It stops you over trading. You get 1, 2, or 3 cracks a day. That's it. If it doesn't work out, you stop trading because it's not the right market. When it does go, it's nice and profitable. The strike rate is low, however, at 20 to 25%. So it's going to be one of those strategies. If you're annoyed by stop losses, this is going to drive you nuts. But long term, it's going to create a nice profitable edge. So it's something I think I'm going to work on, and I'd like to get it out live. But I need to verify some test results, and I need to come up with some decent, robust set files that I can verify, basically, and out of sample test. So a bit more work to do, but it's good. Looks good. But we know it's good because it's been around for ages. Yeah, the opening range breakout strategy has been around. Larry Connors came out with it a long time. Not Larry Connors. Tony Krabel came up with it a long time ago, and it's been used in stocks for decades. Yeah, and it's proven. It's a proven thing. As long as the opening bell rings, the opening range breakouts will work. That's it. If we move so far into electronic trading that Globex takes over from the open, it will not work. Yeah, that's the only danger to the strategy. Right, there we go. That's it. Done. Any questions on anything? I've waffled on for a long time this morning. Mind you, it's only an hour. It's not that long. EuroCAD. We're coming. My final trade on this account. I'm going to empty this account today. Well, not empty. I'm going to transfer it back into my wallet. Just because I've segregated the strategies. So looking basically for a push down today. ADR is 94. So I need to get to 150 ADR for the EA to TP me. That is more likely a potential support. Obviously with the euro today, I mean, it's a quarter of an ADR basically. So for the sake of a quarter of an ADR, I'm not going to risk this support holding here, this propulsion gap fill being resistance, support to the downside. So that's where the EA gets me out. It doesn't make sense for that to happen in the EA, just to let this thing carry on in drawdown. So yeah, I will get out just there. And hopefully we get that on the news. We get the news spike off of the interest rates at when is it? 1:15. And if not, hopefully Lagarde will 1:45. Lagarde will sort it out. Sort it out, Lagarde. Drop it for me. For someone like me that after discovering position trading is not so keen to use a stop loss strategy, it's probably better to set it up, let it run and watch it at quarter's end. Eyes don't see. Yes. Very similar to what I'm doing with the trend strategy. I'm the same as you, Evil. I can't bear to watch losses occur. I don't think anybody can. You know, so this strategy, the trend pullback strategy, hasn't done a lot this week because we haven't had a lot of hasn't had many pullbacks really on the yen pairs. But you know, this is sitting up at 25 grand. It started at 25 grand. It's taken some lovely wins and some lovely losses. I'm just not looking at it. It's just sitting there, and I look at it every day, obviously, because I come into the VPS and it's there and I look at it every day, but I'm not obsessing with it. I'm not checking it on a daily basis because it will drive me nuts, because I'll see it lose and I'll see it lose and I'll see it lose and I'll go, this is not going to work, and I'll want to turn it off, and then all of a sudden it pulls back 5 grand in a day and you're like, yes, I remember from the back test this is what it does, but it drives you mental. And this is why I switched from ORB to SIH, because ORB drives me a little bit crazy as well. The edge is there, and it's one of those edges which, when you look at the P&Ls on them, it's an edge that is hard on the nerves. Yeah. I mean, that is obviously an issue, the lot multiplication part. I mean, this is an out of sample test. And I will do some testing with lot multiplication. I mean, the way to stop this is to use a lower lot multiplication. I don't know what we were using, 1.4. I mean, let's try it without lot multiplication and just see what result we get. But it's one of those strategies that, you know, every single one of these little jagged lines is a loss, is a pain. Is that it? That was quick. But, you know, this is the edge. But this is, what did I say it did? 300 trades a month. 5, 6, 7, 8. That's a month with no income. Yeah, but that is a month of nothing but income with a little bit of a blip in the middle. Yeah, and this is the thing. This is going to happen. Yeah, this is a breakout strategy. It wasn't breaking out. It really was breaking out. It wasn't breaking out. It was breaking out. It was breaking out a bit, but then not breaking out. Then it broke out. Then it didn't break out. Then it broke out. Then it didn't do much. Then it broke out. Then it had no breakouts. Yeah, this is life. We know 25% of the time we're going to get lovely results, which means that 75% of the days, yeah, let's look at a trading week. 1.5 days of the week, you're going to be happy. 3.5 days of the week, you're going to be pulling your hair out going, this is just not working. But it will work. But it is going to drive you mad. So don't look at it. So SIH is smoother than ORB. SIH is different to ORB in the fact that it only takes 1 trade a day. That's the difference. So this is no lot multiplication. So you are getting a drawdown of 1,000 to make 2.5. Yeah. So you give me 1, I give you 2.5 back in a year. Right. So let's multiply that. You give me 10, I give you 25. Yeah. Starting salary as an engineer apprentice is 25 grand. So jack your job in right now, give me 10 grand and I'll give you an apprentice salary today. Only though, if you trade the DAX. Yeah. If you want to add the NASDAQ and the S&P into it, you can have a fully qualified 5-year engineer salary of 75 grand today. Yeah. But along the lines, 3 days of the week when you come into work, I'm going to hit you over the head for 4 hours a day and tell you you're a crap at your job. 2 days of the week, I'm going to go, well done. Would you like a coffee? I'll get you a sandwich. Yeah, that's your job. Do you want that job or not? Because that's what stop loss strategies are. They're horrible. But they do make money. But not that. They make that. It's pain. It's pain. SIH, and that's because you're going, oh, it's a long, no, it's a short. Oh, it's a long, no, it's a short. Oh, it's a long, and you've got every day you've got highs and lows. SIH is, oh, sit around all day doing nothing. There's no stress, there's no pressure. You know that you have got a loss. So the equity curve is equally as spiky, but the spikes are bigger and pointier because you've got less of that going on, because there's a hell of a lot less entries taken with SIH, which is why I liked it. I'm sitting here right now knowing full well that I've got a double hedge on, and I couldn't give a monkey's because nothing is happening. The very worst thing that can happen to me today is $400 loss. They could both get 5R loss recoveries and come back and make me a lovely $400 to $600 pound, in this case, profit. But I've got no stress. If I'm sitting here watching this thing break long, sit around for ages, I'm going, should I shut it? Should I not? Should I do this? Should I not? What if it gets there? That looks like a support. All that. That's what you have to do if you're taking multiple trades. So they're always going to be like that. There's nothing you can do. You either get in and forget it, or you get in and try again and again and again. And the trouble with the original ORB EA and the original ORB strategy is it has unlimited attempts at entry if the market is choppy, which can lead to very big losing days, but it also leads to very big winning days, or a lot of if you look at the original ORB P&Ls, it's a very different equity curve to this. Look, it's a lot more smoothed because it's constantly trying to make money. So there's a hell of a lot more trading going on with these these variations, and there's a lot more stagnation, but it's gradual growth. Whereas this equity curve is a lot choppier. There's a lot more big spiky movement in it. So it's a different variation, but it does the same thing at the end of the day, if you think about it. But this one limits it to a max 3 loss. Now, obviously, I still haven't tested the 30 and the 60 ORBs, or rather the initial balance, and I don't know what you call that. I've never actually known anybody trade the 30-minute opening range, but the 5, 10, 15 are common variations, as the 1 minute is, and the 60, which is called the initial balance in futures, is very widely used. The 30 is kind of your initial candlestick in the TPO on futures, so it makes sense that you're taking a breakout of the first 30-minute TPO, which a lot of attention is paid to at the value area high and the value area low of the 30-minute TPO. So that does make sense in that it will often reject it, but if it breaks it, you quite often will run for the day, because what it will do is it will paint that initial TPO, and then if it breaks that, what you're going to paint is a P-shape profile or a B-shape profile for the day, which is a trend day. So it does make sense that 30-minute would be, if and when it breaks, which could well probably be 20% of the time again, it would be a good profitable break. But whether or not you would achieve a 3R out of it, if it was 20%, you've got to do 20, 40, 60, 80. So you need to move 80% of the average daily range. 56% of days it will achieve that. You know, so there's a lot of testing needs to be done to see if whether or not it's actually viable to use and whether you should trade them. The other thing you can do with this, obviously, is you could test each individual one. So if I set that to 0, I would only test the 10-minute ORB, or only test the 15-minute ORB. Yeah. And a combination of all of them. So there's lots of other permutation tests we could do to say, should we just do the 5? So what happens if we just take the 5 and do nothing else? Worst case scenario, we're going to get one long, one short, and that's it. We're done for the day. Yeah, that's it, isn't it? If it just goes that way and just goes that way and both of them stop out, we're stuffed. So there's a million tests you can do with it. There's a million variations you can run, but I like the idea of, let's try the 5 and see if it works. Same as pre-market. Some days the pre-market range just goes and that's it. We're done within 20 minutes. We're like, this is easy, isn't it? Those are the days where your boss is patting you on the head, giving you a cup of coffee and asking what to buy you for lunch. Other days, We go long on the 5-minute ORB. It comes down, it sits around for 25 minutes and stops us out, takes us short, and then goes up and sits around here. 3 hours later, there's a news event in New York which does that. And we're like, for God's sake, if I had stopped out on that, stopped out of that, and taken the 1 hour initial balance, I'd be milking it today. We can do that. But is it right to do that? This is where testing comes in. And this is why there is no good way or bad way. I can give you 1,700 ways to trade the first 15 minutes of the opening range and make money and make profit. Which is right, which is wrong? No idea. They all are. Some days they're all right, some days they're all wrong. Some days multiple ones of them will be right. But your job is not easy because you can't pick one. There's 1,700 versions which work. Well, there's not actually. There's 1,671 versions that work. Yeah, out of 1,700. There's 1,600 ways to make money out of 1,700. So in effect, if you do the ORB wrong, there's only actually 58 ways to do it. The rest of them will make money. You can't get to the end of the year without making money, apart from 58 out of 1,700 ways of doing it wrong. It's just nuts. It is a massive edge, but this is where your kind of judgment has to come into it. There is, there's a, what do you want to take, the 10 or the 5? Brilliant. You take the 5, I'll take the 10. Some days you'll be going, nah, 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 nah. Other days I'll be going, nah, 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 nah. You'll be going, crap, lost twice today. I'll be going, I won twice today. Yeah. Right. Broker, I think I would run it without lot multiplication. Yeah, I mean, again, we can see it works without lot multiplication. It's not as good. You're going to get more chop. But this kind of links into the session we did last week on why are you doing this? If you're doing this to buy a Lamborghini, ORB is not your bag. Yeah. If you're doing this to make a better return on a pension fund than you will get investing in the S&P 500, this is your bag. If you're looking for something that is going to generate enough to make money on as a part-time income, this is it. Yeah, but don't expect it to set the world on fire. Yeah, whatever you multiply this by, it will multiply that. Yeah, so you look at this drawdown column as how much money do I need to make $2,500 a year? You're going to need somewhere in the region of 1,000. So if you stick 1,000 in an account, by the end of the year, you should have 2,500. Yeah, or you're 3,500 because you'll have made 2,500. Yeah, so if you want to pay for a holiday, you're going to need to put maybe 3,000 in the account. And then that will pay for your holiday next year, assuming you want a $7,500 holiday, because I don't think you can take the kids away abroad for a nice 5-star holiday these days without spending $7,500. But this is why are you doing it? If you want to make a constant full-time living out of it, you're going to need 50 to 100 grand in your account, and this will do it. But don't expect to earn £1 million. It's not. This isn't that strategy. This is a strategy that is long-term, consistently profitable, but it doesn't work when the market doesn't suit it. That's the key. Need to keep in mind that it should be strategy that is profitable long-term and stop checking it every day. Yeah, all strategies are like that though with stops. This is the beauty of position trading, and why I love it so much. It's like you can go away for a week, come back, and it doesn't matter. This is what trading's about. Trading for me, when I started doing it, was all about trying to free up my time. The reason I started looking into it was because I had a kid on the way and I wanted to have more time. What it ended up doing was becoming an obsession, which turned into work, which turned into income, which turned into continued, obsession, because you suddenly realize that this thing changes every 5 minutes. Every year it's different. So you have to look for different ways of making money every year, because nothing works consistently every single year. But, you know, we adapt. So SIH is smoother than ORB. I've already covered that. And not to be discouraged by the stagnating periods. Yeah, this is the thing that people, and this is the system hopping bit. Yeah, these periods of stagnation, you cannot. I mean, if you haven't convinced yourself you have an edge, you cannot survive this. And no one does this. There's somebody at the moment that's back testing one of the set files I put out there, and it says, oh, immediately it doesn't work. Well, maybe that one doesn't work on that thing. I haven't tested it on everything, but what I'm looking to do is get in on ADR and watch it. I'm not trying to put out a set file that is exactly going to work on every single thing over every single time period. There isn't a set file that you can take. It works every year. It doesn't exist. So yes, you're going to find it's going to fail. He's obviously got different data to me because he's getting different results. But at the end of the day, I trust my results because I've verified my data. I have no idea what he's doing. He could be using MT5 with bog standard broker data from 8cap. Good luck, you're dead. I've no idea what he's using. But if it says you're not going to get profit out of it, you won't have any faith in it to start with. So the first time it turns around and gives you a bad result, you skip and you move on to something else. And you system hop and hop and hop and hop and hop and hop. But if you know that it's going to stagnate for 3 months, like I know that this strategy is going to have months where it doesn't make money. If I sit here on 25 grand, run it for a month, and I'm still sitting here on 25 grand, I know that's normal. If I'm expecting this to make me 5 grand a month every month, I'm going to dump it and move on to something else. Yeah, it's mindset. You need to know what you're doing. And everybody that's out there hunting for EAs and trawling the marketplace on MQL5 going, I bought this EA, the backtest looked good, I've run it and it doesn't make money. They haven't done a backtest. So why haven't you done a backtest? Well, because he told me it worked. If I told you to jump off a cliff, would you? No. Don't be an idiot. If you want to make money, invest time. No one's going to give you something for free that just works, because they would keep it for themselves, wouldn't they? I share everything that I do in the hope that it educates people on how to do it. But people will just run and do stuff. Yeah, you've got to verify results. Look at how horrible this thing is. It's a terrible strategy. Look at that. If you started on this EA with that set file there, you were gone there. There's no way you hung around for that. Unfortunately, 2 months later, you were making a fortune. But you just saw that and you thought, this is shit, I'm moving on. This is shit, I'm moving on. This is shit, I'm moving on. I didn't move on. And I'm 28 grand up. But that doesn't work, that strategy. Yes, it does. You just didn't stick around for the winning bit, did you? But if you'd have done the test, you'd know you're going to sit through 3 weeks of crap where it's going to get it wrong. Virtually every trade is going to be a hedge or a double-ended breakout that fails. It's just going to be wrong for 20 trades in a row, because that's what it's done in the past. Why are you expecting it not to do that in the future? If it did it in the past, it's probably going to do it again. And when it does it, you go, didn't realize it was going to do that. That's because you didn't do this. I can't help you if you don't do that. It's part of the job. Yeah, it's such an important thing. This is why I spent the entire first week when we were doing the member streams on nothing but, it was first week and a half, wasn't it? Robustness testing, system testing, parameter permutation testing, out of sample testing. It's absolutely critical, because it's not so much to prove strategy, it's to prove to yourself that this thing has an edge and that you know what's going to happen. In position trading, I'm going to go into 15% drawdown at times because I've done it in the past. My testing told me that we're going to happen in the past, and it's going to happen in the future. There's going to be squeezes, and I'm going to get squeezed, and it's going to be painful. I'm going to sit through it, and I'm going to get out the other end of it, and it's going to make months like this, but it's going to make months with a negative in front of that as well. But I know that because I've tested it. And this is what this is all about, doing all of this. And this is why I don't have many strategies, because I've done 1,000 tests that come out like this. And I've got 1,000 strategies that have this type of return on drawdown. but they all give me roughly the same. What's the point in running 5 breakout strategies that give me roughly the same outcome? Why don't I just 5x this one? That's the same thing, doesn't it? But having one trend, one mean reversion, and one breakout, that is complete diversification. And one position trade, or actually I've got 2 position trading strategies. I have the zone trader and I have the indicator version of position trading. They both are position trading, but they're both taking different trades. They are diversified. I'll be in one thing while I'm not in another thing. Yeah, chopping it around. ORB, well, if I have a bad month on position trading and ORB is killing it like it is this month, that pays for that. If I have an amazing month like I am this month on position trading and zone trading and ORB, I'm booking a holiday. But equally, all 3 of them could be crap. Yeah, unlikely, because the trend strategy, the position trading is all mean reversion. The trend strategy will work when the mean reversion isn't most of the time, because if I'm going into a squeeze, I'm probably on a trend. Diversification. But it's about identifying all of that. You know, this is what the job is about. It's about finding edges, testing edges, deploying edges, sitting there and just letting the edges play out. It's not a fun job. This is why people find it so hard. I find it so hard to sit in a live room and find things to talk about, because I sit here and go, there's no ADRs today, there's no RSIs today, there's no news today. Anybody see the telly last night? Because there's nothing to do. There's nothing to do. If there's nothing happening, there's nothing to do. You could try and find things to do, but that leads to overtrading, and then it all goes wrong. It's just what it is, isn't it? This is why everybody gets stuck, because they think they need to be in the market. You don't need to be in the market. You need to wait for the market to be in a position that you want to take advantage of. And if it doesn't get there, you don't do anything. Looks very promising. Yeah. Those results 1 year. Yeah. Which ones? All these tests, yeah. So these are initial. Again, these are only initial tests over a year. The tests over a year that I do are to get a high volume of data over a short period, or relatively short period of time. I mean, a year's quite long, but it's to get as many parameter permutation tests done as possible to help identify what isn't worth pursuing and what is worth using as a variable to test. Then out of sample test, whatever we come up with in here, which I just did, and obviously that still gave an equity curve that's profitable. So if you in sample test, nice curve, out of sample test, nice curve, different curve, never be the same obviously, but it's still profitable, i.e. generating alpha, high return on drawdown, or better return on drawdown than not. You've got robustness. So now I've parameter permutation tested it and out of sample tested it over a period twice as long as the initial sample. So I've got 3 years worth of profitable, robust. Yeah. Now it's a case of develop further trailing stops and retest some of these variables with trailing stops. Should I add the 30 and the 60 in? And just fiddling around, really. But as long as you're doing tests and you're getting the vast majority of results coming out positive, that's it. But testing over 1 year is quick. So this test, I think, the permutation test on this, I think, was about an hour per, less than that actually, less than an hour an instrument. Yeah, 57 minutes. So basically 4 hours, 4 indices, half a day, done. Then I can look at those results. If I run a test over 4 years initially, so if I do a post-COVID test on my initial in-sample run, I will get better quality data, but it's going to take me 16 hours to run that test. So then I need to move back to pre-COVID testing. So yeah. But obviously you've got to test it over a longer period. Thanks for the obsession. Yeah. Really like the new design of the content on the website. Cool. Yeah, I'm still working on that. It's going to take a long time. This is the only page I've done, and it's taken me a week to do it. It's just because I don't have time, but just want to get everything clear, and just, you know, just, I think it's more for me to try and minimize the number of questions I get, because I get constant DMs, which I don't mind, but you know, when you're constantly got Discord and Telegram pinging at you, and I'm constantly saying to most people, have you watched that video? No. Which part of it? And they're rightly saying it's 2 hours long in the boot camp. Which bit are you talking about? So by getting an entire strategy boiled down into 3 to 5 minutes means I can just say, that's how the mean reversion RSI strategy works. These are all the inputs that affect it. Go and look at all of that. You don't even have to read the manual, because, you know, just trying to make it a little bit simpler for people, basically. But, you know, it takes a lot of time to redo all of this. I could employ someone to do it, but I don't trust anyone. It's me. I need to do things myself, which takes twice as long, but at least I get it exactly as I want it. So there's the trouble. You can't trust anybody else's data. You can't trust anybody else's anything. You've got to do everything yourself. Otherwise, you can't verify anything. We're really not going anywhere on the indices today. I'm not surprised about the DAX, to be honest, because obviously we've got the ECB rate today. So I think we'll be sitting around here. Need to be a bit wary of this one today, because obviously if we do get a real big shock on the DAX today, downside target is weekly support, which is very nice. Upside target is higher, you know, all-time highs. So just be aware that we may well get an ADR hit on this today. So be careful if you're using the hedging. You may have to re-hedge this, but we'll see. I'm not expecting a massive shock today, because Lagarde's been very open about what she's doing. We've been told it's coming down. We knew it's coming down. The market's factored in it's coming down. Nobody's expecting her to come out in the press conference to say anything but we're going to continue to drop rates because inflation is continuing to go the right way. So I don't think we'll get a shock on this today. That's the one I thought we were going to get a shock on, but we didn't. So we'll see how that goes. But afternoon, 1:15, 1:45 is what we want to watch. All right, so that's it for today. I will be back tomorrow morning, and we'll obviously do a recap of the week and a recap of the month, really, tomorrow, because it's the last day of the month. So if I can get this over the line with 0.5%, what I would really like today is 0.66 profit, because that would take me up to exactly 15%. I wonder if I could engineer it so I can get exactly 0.66 in the bank. That'd be good, wouldn't it? 15%. That's a good month. Yeah. Remember from the position trading bootcamp, somewhere between 5 to 15%. This is upper end month. Very good. Because the market has been nice this month. And as you can see, flat. And one of the other things that is different this month, and this is the first full month where every trade taken in December and January was in line with swap. This is the first full month's results with purely swap directional trading. So massive difference, massive difference. A lot less stress, a lot less drawdown, a lot less entries, but a lot more accuracy. So we'll see if this continues. But I was looking through my P&L yesterday in preparation for a video I wanted to do tomorrow. And I suddenly twigged that every trade closed out this month was opened in December or January. December is when I swapped to swap direction. Weird, isn't it? You never see me with a flat P&L. And you never see me, well, never see me with a green P&L. You quite often see me with a green P&L, but not consistently, you know, flat. I don't go flat. When have I never got exposure on? It just doesn't happen, does it? So I got a feeling this may be the holy grail of position trading at the moment. Whether it continues to be or not, we'll have to wait and see. But this seems to have made quite an impact. But obviously, it's only 1 month. So, and obviously, the other thing to bear in mind is the Zone Trader account is only also trading in line most of the time with swap, and that's done 17% on no drawdown as well. So, you know, this isn't actually strictly true, because this has been trading in the opposite direction, but the majority of trades have been in line with swap. So, but is it a coincidence? Can't backtest it. There is no historical data on it, unfortunately. I would love to. I asked my broker. I contacted RoboForex's support the other day, and they put me through to their technical team because I was asking about historical data. And I asked them basically, can I have, or have you got historical swap data figures? And they basically haven't. So it's on my list of to-dos to see if I can contact some of the other brokers that I deal with and dealt with to see if they can provide historical swap data, because if they can, I can produce an EA to backtest historical swaps, which means that we can backtest whether or not there is an actionable edge in swap direction. But because there's no way of plotting it, there's no way of testing it. So we'll have to wait and see on that one. But yeah. But the thing that's worrying me at the moment is I've got no exposure. Obviously, can't make money if I haven't got any exposure. So hopefully we get some movement. So you think trading in line with the swap is best, less stress? Yeah. Well, I don't know. I mean, the only reason like I said, the only reason I've implemented this rule is because I did an analysis back in November or October when I had that really bad run in a quarter. I did an analysis, and over 30 grand's worth of swap costs in total were put through the account. So when you look at, 30 grand is a lot. Admittedly, it's a big account, but it's not massive. It's a massive amount. So somewhere between 10 to 30% of the drawdown costs were swap fees, which is too much. So it made logical sense to remove anything that was large and just concentrate on things which are small. Now, the thing to remember here is that banks and institutions also pay these figures. Yeah, this is what the overnight rate is. Yeah, so when you hear the banks and institutions and the news talking about the overnight rate, look at the news today. Yeah, Fed fund rate, main refinancing rate. Yeah, overnight rate. This is swap. Basically based on interest rates. So what we're effectively doing here is aligning ourselves with the way that the banks can make the most money. So this is why when you look at the Japanese yen, the long trades work better for longer, because you make $9.55 in swap if you buy it, and if you sell it, you have to pay $30 in swap to hold the position. So which way do you think the banks would rather this moved? Would they rather give $30? And they don't pay these numbers, but the brokers charge us in equivalent rates because they're borrowing on your account. So when you put 10 grand into your account, they take out a loan for 10 grand. You pay a swap fee, which is the interest rate on your account. This is what swaps are. So you're paying to go short. Do you think they'd rather do that or that? Obviously, they'd rather do that. Now, if they're going to do that and we do that, haven't we got much more chance of making money? Yeah. So, again, I can't confirm this because obviously it's never come into when in the past, and this is the thing with swaps. In the last, I would say 6-7 years, we've had very low interest rates everywhere until COVID hit. COVID drove us into negative interest rates or zero interest rates virtually everywhere. Then after COVID in 2021, we started the interest rate rally. All the time I was trading before and after COVID, this didn't come into the equation. There was virtually no swap fees. It doesn't matter what you did, you didn't pay much. But since 2021, 2022 specifically, and 2023-24 dramatically, the cost of holding positions long term has increased tenfold, more than tenfold. So when you actually look at movement based on swap, the short moves are faster and harder a lot of the time than the long moves. I don't know what the swaps were back here or anywhere else, but you know, I just don't know is the honest answer, because I can't test it. But look, I mean, this is costing 6.40 to go long on the euro pound daily, and it's virtually nothing to go short. So I'm only taking shorts, and I should have only been taking shorts since 2023. I don't know what these have been. I'd love to test this data. So if any of you have got other brokers and want to put in a little ask and say, I mean, a spreadsheet, text file, whatever, doesn't matter how you get it. I'd love to get the data so that I could plot that data and do an analysis, because I think there could be an edge there. Obviously, the edge will disappear if interest rate differentials change, which they will, and they are. So stuff that is not tradable will become tradable, and stuff that isn't tradable isn't tradable will become tradable. Yeah, that's sitting at 560 swap to go long at the moment on the pound US dollar. I've only been taking shorts, but as soon as that drops below 5, it opens up the EA to start longing it. So but that will be right, because what that will indicate is that the US dollar interest rate has dropped and the pound hasn't. So therefore these become similar. If you look at the interest rate differential between the pound 4.75 and the dollar 4.25, that is why these figures are close together, 5.6 and 2.7, because there is a slight edge over one than the other. If you look at the difference between the Japanese yen at 0.5 interest rate and the pound at 4.75, cost you $40 to hold it, because the difference between 0.5 and 4.75 is vast. So the differential is not good for the yen, isn't it? Because the yen's is tiny and the pound's is massive. So what do you want to do? If you put 100,000 in the bank, would you rather have 0.5% interest or 4.75% interest? Obviously, you're going to hold more pounds than yen. Therefore, you buy more pounds than yen. Therefore, the pound yen goes up. This is what this is. It's telling you which way you should, where you should put your money if you want to make money. Yeah. Sun's coming in. I've actually got sun. Bizarre. So yeah. Oh God, I've got artifacts all over the place from an old indicator I was testing, which decided it didn't want to delete stuff after it had drawn it. Annoying. Anyway, yeah. The zone trader did really well. Is that the advantage of discretion will support resistance levels? Yeah, this is the thing with the zone trader strategy. There isn't a strategy. I tried to build this. I spent a long time trying to automatically identify support and resistance, because there is no way of doing it. It's completely discretionary. There's 1,000 different algorithms and logical ways that you can find areas. I think this is why I just released it as a tool to draw what you think is right in, because what you think is right is what you think is right. Whether the market thinks it's right or not is a 50-50 shot. I don't know. I'm thinking here. Someone else may be thinking here. Well done. You got it right. I got it wrong. In fact, I didn't. I got it right because that's where I had it before. But we both got it right. Yeah. But, that's the point. What's right and what's wrong? The right is where it turns. The wrong is where it doesn't turn. You don't know that until it's got there. So all you can do is draw. It's all discretion. Some people now, I'm long here heading for that. Some people might be heading for this. Some people might be heading for this. Some people might be heading for that. Some people may be where I am. Others might be out already on that. Totally discretionary. But what the market will now do is that or that. So we'll target that and that. If you're out and flat and you want to find somewhere to get in, try one of them. Or that. Try wherever you want. Doesn't matter, does it? It's nothing to do with entry. It's to do with exit. It's to do with how you adjust your price and scale into the swing that's happening. That's what makes you the money. That helps, I think, because that's what the market wants to do. The market needs to put $100 million somewhere. Where should we put it, everybody? In the place that earns us 1% or the place that earns us 4.5%. Where should we put our money? The place that earns us 4.5%. When I placed my trade in the direction of the place that earned me 1%, I was in pain for weeks. Now I've put my money into the place that earns me 4.5%. I've only got in once and I'm already in pleasure. Is it because of that? This is trading. There is no way to identify what to do. You have to just do something. It's all about risk management. You are a risk taker. Your job is to take risk. That's it. You adjust your strategy around what the market is doing. That's it. So I get in, and because I don't know where it's going, I then wait for the market to show me where it's going, and then I will adjust my trade accordingly. Every single strategy out there that anyone will ever try to teach you is trying to teach you how to get into the market when the market is going to do something, as if they know what the market is going to do. Yeah, banks and institutions get it wrong all the time. How many times do we see an interest rate come out different to what they were expecting and a spike that goes to 300 ADR? That's because the banks got it wrong. If they get it wrong, how on earth do you think some guru on YouTube with gold tooth and a load of gold chains around his neck is going to tell you which way price is going to go? No clue. No one can. I can't. I don't know. But what I do know is it goes up and down. That's it. That's all you have. So all you have to do is apply strategy around price going up and down. To do that, you cannot select a point where it's going to turn, because you can't do that, because you don't know. So this is why, it's not that the zone trader has done well. It's that the market has moved up and down. It's not that the position trading account with RSI has done well. It's that it's moved up and down a lot this month. That's what it's done. It hasn't done that, and it hasn't done that. Therefore, we've had a really good month. Doesn't matter how you got in, whether you zone traded ADR, RSI, stochastic, CCI, MACD, Bollinger. Doesn't matter what you did. If you were mean reversion trading this month, you did well, because we haven't had a parabolic squeeze. We will do. But my unknown is, are the parabolic squeezes ever going to go against the swap direction? And that is something I'd love to test. So unfortunately, you can't. But I have looked. I've Googled it. And this is all I came across. Anyone know where I can find? And no answers. I found this website that provides historical swap rates. I wrote a crawl to extract the information from the website. That one. Net swap system site. What's this? I didn't find this one. The first result on Google. I found charts and things like this, but you couldn't this didn't help. I couldn't get the data out of this. I tried to get data out of that. Look at that. I totally agree with everything he says. Like this guy, this website, whoever this is. Well, there's no historical data, is there? That's a lie. Anyway. Fibbo Group. This is a broker, isn't it? Okay, so this is what I was after, a broker that supplies this. Sorry, I'm just waffling now. I've gone off on one. So you can leave if you want. But so you got to crawl this data out. Let me just see what this guy's got. This might be interesting. Updated the 30th of January 2025. Holy crap. Look at this. Swap data going back to 2016. Up to 2024. February. So that's interest rate freeze. So that's up to the interest rate freeze. I just found it. Okay. And I've got all the forex pairs left. Look how little they change. Very rarely change. It's so marginal, the actual differentials, until the interest rates change. Look, and now all of a sudden we've got 1.23 where we started at minus 0.18. This is where the interest rates started changing. And then 2021 and 2020, we start getting back to virtually no differentials because we had zero interest rates. And then the interest rate rallies all start in 2022. And we start getting the differentials getting bigger and bigger. And then we got a 1% differential between them now. Right, this is interesting. So this may well help me plot that data and somehow get it into the position trader EA to back test it. There we go. I'm slightly excited now, but I can't do that because I've got other stuff to do. So it's a project. If you want that data, if you want to play around with it, it's there. I'll stick the link in there because that way then I've got the link and I'll never forget it. So this guy, this zip file that I just downloaded, which was February the 12th, 2024, was scraped from this website. So he's obviously got some kind of scraper, but this is, so you can basically just select a date. Write a Python script just to quickly grab that. Boys. Let me just check the US dollar yen. 136 minus 226, yeah. The pound yen be similar. 124, 3.4, yeah. We like it. So basically, to interpret these numbers, you get paid to go long, you have to pay to go short. You get paid a little bit, you have to pay a little bit. You don't have to pay, they don't pay you, but you do have to pay to go short. Yeah, so if it's a negative number, it costs you money. If it's a positive number, you get paid money. That's basically what is interpreted on the chart there. But these are the actual numbers that your broker. So what we'd have to do, or I'd have to do, is extrapolate that into the broker charges because they're not the same, obviously. So whereas pound yen cost 40.23 and 12.13, obviously it's 124 and 3.4. So 34 and 12, does that equate in that way? 12 and 43. So it may be a case of you could just 10x these. So that pound Swiss would be 870 to go long and 19 to short on the pound Swiss. 620 to go long and 19 to go short. Brilliant. Okay, so you 10x those numbers, and that's going to give you a rough idea on what the swap cost would have been on each date. Thank you, Fibo Group. This was not there. This didn't. This, I swear, I've done this search and this did not come up. I spent hours looking for historical swaps and I couldn't find them. Apart, I could find the odd chart here and there you couldn't get data out of, or something you couldn't scrape money from, scrape anything out of, or something I couldn't understand, which is probably this. There's all the China stuff. Yeah, I looked at that one. Anyway, there we go. Weekly swaps report. Oh, that's the FTC. Spread data. Got loads of that. Spread data everywhere. Cool. Right, new project. There we go. That's next thing on my list. Right, I will go now. You can go now. I'll be back tomorrow. Anything you need, let me know. Other than that, I will be around in Discord. And I'll be working on this more over the coming week, doing some more testing. I'm going to rerun all the DAX tests today, and I'll put the data out there when I've got something more conclusive, and then I will start forward testing a variation which you can have a look at in back tests, and yeah, we'll see if we can find another variation that's a little bit better at making consistent money than the original ORB. And a little bit in between the SIH. So we will look at it in more detail, but whether I run it or not will depend on the results. So at the moment, they look pretty promising. All right, so have a good day. Anything you need, let me know in Discord or Telegram. I will be back tomorrow morning, 8 o'clock. And if I don't speak to you before then, I will see you then. Have a good day.